Any vacations planned, Jordan?
Nothing imminent. My wife and I actually just got back from Dallas. We were at like the Passive Income MD conference that
Oh,
I was talking at, and then we kind of made it a little vacation as well. Um, but we're trying to plan something. We want to try and go. My wife's from Puerto Rico, so we want to try and go there. Um, hopefully in the winter months, kind of get away from the
yeah.
Buffalo snow.
Yeah.
Sure.
Old San Juan is really nice.
Yes, it's
Yeah.
beautiful. Yeah.
Yeah, the seafood's really good.
Yes. Yeah. So we are, and our kids have never been there because it was, they were born around COVID time kind of and
Yeah.
stuff. So, and then things have just been busy. So it'll be exciting for them.
Yeah. There's not like much to do for kids, maybe, but
Yeah. They're like pretty easy to please as long as there's like a pool somewhere and we can take them to the beach and
yeah,
they
I'm sure there will be. Yeah.
run around and entertain themselves.
Yeah. Yeah. But the food is amazing.
Yeah.
Food is phenomenal.
All right. Well, I think let's get started.
All right.
So thanks everyone for joining. I'm excited. We have many of you hopefully joined our previous webinar. I have Lubna and Paul Chano, who are the founding members of Tax Planning Boutique, a couture tax planning business that focuses largely on medical professionals. So I'm really excited to have them. They're a wealth of experience. You may have seen in our Facebook group, their newsletters that they've posted, and we were just talking about that before. How, I'm on the email list for the newsletters and always learn a ton. So huge wealth of information. I asked them to come and talk in the beginning specifically about taxes and tax planning specific to real estate, because there's always a lot of questions that come up with that. And it's also real estate is a huge vehicle to, kind of shelter and plan your taxes around. After that, we'll have time for a Q&A. It can be questions about taxes specific to real estate or just general questions. Like I said, they offer a wealth of information and have been very gracious sharing it with us. So with that, I'll let you guys take it away. And Paul, I'll let you start with the tax planning and real estate.
All right. Thanks, Jordan. Hello, everyone. Hope everyone's doing well. My name is Paul Chano, and I'm a tax planning strategist. We help business owners and real estate investors pay less tax. I'm an enrolled agent licensed by the United States Department of Treasury, and I'm authorized to practice in front of the IRS. And I'm also a certified real estate tax strategist. I'm part of Tax Planning Boutique with Lubna Chano, and we're here to explain to you what tax planning is and how it can be useful in real estate. Now, before we get into the real estate, the number one problem that people have is failing to plan. If you fail to plan, you plan to fail. Tax planning is so important for three reasons. The first reason is it's the key to financial defense. Now, us professionals, us business owners, or us, W-2 earners, we're really good at financial offense. Financial offense is making that money and putting it in our pocket. But what we really need to do is be financial defense. Financial defense is minimizing our expenses. And our number one expense for most of us here is taxes. Number two, the reason why tax planning is so important is because it guarantees results. I can guarantee you if you're buying your next rental property, I can guarantee you tax savings. And number three, beating the IRS is so much fun. If you have a pool in your backyard, I have 5 words for you: on-site employee athletic training facility. Now, a Supreme Court justice once said, there is nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. And that's coming all the way from a Supreme Court justice. So it's really important to know if you're taking advantage of everything in your situation. Now, before we get into the rental strategies that I'm going to show you, it's important to know some basic foundations on the tax code, really. And what we really need to know is the types of income we have when we're forming our tax bill. So in the tax code, there are 3 different types of income and loss. There's active, passive, and portfolio. Active will be your normal job, your medical practice could be, and your passive income could be your rentals. Your portfolio income could be sale of stock, But for this presentation, we're going to just talk about active and passive income. Now, when you have passive income, there are pros and cons. The benefits are that you don't have to pay self-employment tax and you don't have to pay Medicare and Social Security tax as you do with active income. But the problems with passive income is that your net losses are limited on your net income for passive income only. If you have excess net loss in passive income and loss, you have to carry forward those until you have more passive income to offset that with. Now with active income, only the active losses offset the other active income. You must pay self-employment tax and you must pay Medicare and Social Security tax. Now, there's some rules in the tax code called passive activity loss rules. As I mentioned, rentals generate passive losses, but you can offset a certain amount of passive losses with your active income if you make less than $100,000. You can deduct $25,000. But for most of us here, maybe we are exceeding that threshold because that threshold starts to phase out from $100,000 to $150,000. If you make more than that, there are no losses allowable from your passive losses against your active income. Now, as I said before, these passive losses will carry forward and offset other passive income in the future. But you have to wonder to yourself, why would I want losses? Well, if you own rental properties, let's look at this example. So from a cash flow point of view, let's say I have a rental property. I am making $12,000 a year in rent, and I have my expenses, insurance, taxes, interests, and operating expenses. And in my bank account at the end of the year, I have $3,400 cash. What I'm going to report on my tax return is the same thing, except I'm going to report depreciation, which will wipe out my income, and that's going to give me a rental loss. But the problem is, if you make more than $150,000, that $1,800 of rental loss there, you can't offset that with your active income. But I'm going to show you two ways on how you can do that with your rentals. Now, you can do that if you have short-term rentals or long-term rentals. You can actually generate a loss and turn those from passive into active loss and offset that with your active income, whether it's from your medical practice or even on your W-2. This applies to everyone. Now, there are two factors for short-term rentals and long-term rentals in order to turn your passive losses into active. For both short-term and long-term rentals, you must materially participate. Now, in the tax code, there are two types of participation. There's material participation and active participation, and it's very misleading. Active participation is your standard rental landlord, right? You're buying the property, you're putting the tenant in, you're hiring the management company to take care of the day-to-day aspects of the business, and you're just looking at things from the management point of view, what your cash flow is, your profit and loss. That's all you're doing. That's called active participation. But what I'm talking about is material participation, which is involvement in the day-to-day operations of your business, of your rental properties. Now, I'm not saying you have to do all of the work, but you should contribute to your work. Now, with short-term rental specifically, I also have to average 7 days or less per occupant throughout the year. What this means is as long as in my Airbnb, I have all of my tenants, all of my guests, some of them are 5 guests at a time, 5 nights at a time, 2 nights, 3 nights, things like that. As long as it averages 7 days or less throughout the year, then I satisfy this requirement and I can turn my passive losses active. Now with long-term rentals, I must be a real estate professional, and I'm going to tell you exactly how to get that status. But first, I'm going to tell you how you can materially participate. Now, in the tax code, there are 7 ways to materially participate, and you only have to hit one. And I'm going to tell you which one's the easiest. The first way is to put in 500 hours or more in your rental properties. This could be renovations, this could be the management, the cleaning, responding to complaints from your tenants, things like that. Number 2, you have to do substantially all of the participation. Number 3, which is the easiest, you must hit 100 hours and more hours than anyone else. What this means is, let's say I put 120 hours into my rental property, renovations, cleaning, things like that. I can still hire cleaners and I can still hire contractors, but they cannot work more than 120 hours, more than my hours. That's what this rule means. Number 4, significant participation activities for 500 or more hours. Number 5, materially participated in 5 of the last 10 years, which this is a great rule. If I use rule number 3 for the last 5 years, I can use rule number 5 and not have to actually materially participate for the next 5 years because of rule number 5. Rule number 6, which is pretty niche, personal service activity with material participation in 1 of the last 3 years. And number 7, I participated on a regular, continuous, and substantial basis during the year. Now, what this rule means is that I'm not doing anything else other than working on my rental properties, and I'm doing it regularly on a day-to-day basis, and that's all I do. And that doesn't meet most of us here, but it could. Now, once again, you only have to hit 1 of these 7, and number 3 is the easiest to hit and the most common to hit. And just to make sure, you have to materially participate on both your short-term rentals and your long-term rentals. And the hours for short-term rentals only apply to short-term rentals. The hours for long-term rentals only apply to long-term rentals. Now, with real estate professional status, this only applies to long-term rentals. Real estate professional status is a specific status in the tax code, which helps you with the long-term rentals. And the way to do this is to perform more than 750 hours of service during the year in real property trades or businesses, and more than half of the services in all trades or businesses during the year were in real property trades or businesses. What does this mean? Now, let's say I put 750 hours into my rental property, but I'm a full-time doctor. What the second part of this rule is saying is more than half of my time must be in real estate. Now, if I'm a full-time doctor, even if I hit 750 hours, I can't get real estate professional status. Being a full-time employee, let's say, is 2,000 hours throughout the year. Now, even though I hit 750 hours, technically I have to hit more than 2,000 hours because more than half my time throughout the year has to be in real estate. So this is what gets most full-time workers, whether you're doctors or engineers or anything. This is what catches you. But if you're married, your spouse can definitely be a real estate professional if they have the time, of course. Now, what real estate property trades or businesses are development or redevelopment, construction, acquiring, converting, renting or leasing, operating or managing, or brokering real estate. And realtors fall under the broker category. So if your spouse is a realtor and she meets the 750-hour mark and she's not doing anything else, then chances are that she could qualify as a real estate professional. Now, the last couple of slides, I mentioned a lot of hours. It is really important that you track these hours in the case of an audit, especially when I talk about material participation. Now, as I said in the previous slide, the easiest way to materially participate is to hit 100 hours or more and more than anyone else. And if I'm still hiring cleaners and contractors, that's fine, but I still have to track those hours. Now, an example of tracking your hours could be like this log here. Now, in this particular example, this person is a realtor and they are an investor as well. And they have hours towards their rep status, like home inspection, professional photography, open houses, things like that. And then they have hours from contributing to their rental property, which is closing, removing the carpet, removing the tax strips, things like that. This is what I mean when I say you have to track your hours. I have the date, I know who's doing it, here are the hours, here's what I did, and here's some type of verification. It doesn't have to be very strict verification, but just something, just in case of an audit. If the IRS comes at you and says, prove to me that you worked 100 hours or more and no one worked more than anyone else. Here's my log. Here's how much hours I put in, and here's the cleaner's hours, here's the contractor's hours, here it is. And when you have that prepared, they will drop the case. Now, just to give you an example of why tracking hours is so important, there's a tax court case that came out in 2020, which is fairly recent, of Mr. Lucero. And Mr. Lucero lived in Sacramento, but he had a short-term rental a few hours away. And he didn't track his hours. He maintained the 7 days or less requirement, but he didn't really care. He knew he put in 120 hours, but he didn't track his hours. Now, the IRS came and audited him and said, prove to me that you materially participated. Now, during the audit, he came up with this log, similar to what I had in the last slide, but much exaggerated because, again, it was during the audit. When you get audited, it might be 2 years later, it might be 3 years later. Now, chances are you're not going to remember exactly what you did 2 years later if you're materially participating. So that's why I stress how important it is to track your hours during the year. Now, he came up with this log and he gave it to the IRS and they disagreed. They went all the way to tax court and the tax court reviewed it. And here's what they had to say. So some direct quotes are, work performed by an individual in his capacity as an investor in an activity shall not be treated as participation in the activity unless the individual is directly involved in the day-to-day management or operations of the activity. When they looked at the log, they understood that he made it during the audit. And what they said was post-event ballpark guesstimates of hours do not suffice. They totally threw out the log. They said the log itself is not reliable and therefore is not a reasonable means of establishing material participation hours. Now, they said he didn't materially participate, right? So he had losses offsetting with his active income. They disallowed those losses and he owed $14,596, not including penalties and interest. So this seems like a small case, but there are much bigger cases out there where they owe tens of thousands of dollars after the fact. And you really don't want to put yourself in that situation. So that's why we always advise our clients, please track your hours. Now, another strategy that we normally pair with rental strategies is cost segregation. So normally when it comes to owning real estate, each asset has a class life according to the tax code of how many years you can depreciate your asset. And this is true with any business, but in real estate, normal residential properties, you can depreciate those over 27.5 years, and commercial properties can be depreciated over 39 years. But what cost segregation does is it separates all of the assets in your asset. What do I mean by that? If you have a residential rental property, you don't have just one asset. You can have tens, maybe 100 assets inside this building. And not all of those assets are 27.5 year assets. They could be 5-year personal property assets, 7 years, 15 years. Many assets are in this big building that you're just stretching over 27.5 years. And a cost segregation study lists out all those assets and put them in the class year, and they give you a value and they bottom line everything for you. Now, the cost segregation creates increased cash flow and maximizes deductions, and I'm going to tell you exactly what I mean by that. And then also it creates other tax saving opportunities as well. Now, how it works, when you purchase a property, you must separate the land from the building. And what I mean by that, raw land in the tax code is not depreciable. So let's say I purchase a property for $200,000 and the land is worth $25,000. I cannot depreciate the $200,000. I have to depreciate $175,000 because that $25,000 of land is not depreciable. Now, most people stop here after they separate the land. They divide everything up by 27.5 years. But what you can do is you can further it. Now, I mentioned land is not depreciable, but there are improvements on the land, like your driveway, that is depreciable. And as I said, inside your building, there are assets like personal property that are totally depreciable and much faster, like 5 years. Now, what personal property is? Some examples of that: cabinets, countertops, carpeting, flooring, appliances, things like that. And you may be thinking, these are really like low value items, they're not that low value, and they actually really add up when you put all of them together. And I'll give you an example of that in a couple slides. But some more examples of different asset class lives. So with real property in the 27.5 or 39 years, these are what we call structural components of the building. What really supports the building? The structural part, the roof, the walls, the HVAC system, the plumbing and electrical system, steel structures if applicable. Now with the land improvements, these could be parking lots, driveways, curbs, gutters, sidewalks, even landscaping. So 5 and 7 year properties, flooring, countertops, wall coverings, window treatments, and things like that. Now, let's give you an example. So as I mentioned, let's say I purchase a property for $200,000. I have to separate that land, which is worth $25,000. Now, the building value of this property is $122,000. And inside this building, I have $52,500 worth of 5, 7, and 15-year asset values. So if you don't do a cost segregation, typically you just separate the land, divide everything else up by 27.5 years. But if you do a cost segregation and you pair it with something called bonus depreciation, which lets you accelerate the 5, 7, and 15-year assets up to year one, when you pair those two strategies together, you get a huge write-off in year one. Now, in this example, I take my 5, 7, and 15-year asset values, and I can just expense that in year one through bonus depreciation. Now let's visually look at what the impact is. Now, without any planning, the same example, if I purchase a $200,000 property and the land is worth $25,000, and I just put that off to the side and I take $175,000 and divide it up 27.5 years, through straight line depreciation, I get $6,349 per year of non-cash expenses or paper loss that I'm writing off with my rentals. But if I do planning, which means I do a cost segregation study and I take advantage of the bonus depreciation rules, I have a huge year one write-off, $56,940. Now, if I use this with my long-term rental loophole or my short-term rental loophole, imagine offsetting $56,940 with your active income. You're saving so much money on taxes just from doing this. Now, I'll still have some depreciation for the remainder of the life, $4,440. Now, you should ask yourself, is it worth doing the $6,000 throughout the year, every year? Or is it worth taking this huge expense and only going down $1,000 or $2,000 for the remainder of the life? Now, something that I want to ask you is, when was the last time your tax professional came to you and said, here's an idea I think can save you money? Now, if you want to save some money and pay less tax, the way we operate is like a doctor. You have a problem, you have a diagnosis, and then we give you a prescription, and then you go and fill the prescription. We operate the exact same way as a doctor. So we assess your personal tax returns and your business tax returns, and we go over the missed opportunities in a tax discovery session. And in this session, we'll say, here are 3, 5, 7 tax strategies that we can offer for you. And we'll tell you exactly how much you're going to save with our tax planning proposal. And then you will go and implement that through engagement. And then we'll repeat for next year. Now, we will take questions now, but I highly advise you to scan this QR code, because we do have a weekly newsletter every Thursday where we post really helpful tax tips for you. And if you do have any questions for us and you don't want to mention them in the webinar, you're more than happy to put them in this QR code. This will open a Google form, and you're more than welcome to ask us any questions. And I'll open it up.
Awesome. Thanks so much, Paul. That honestly, I will say is I think probably the most clear breakdown I've seen of all of that. And something, it took me a long time to kind of understand and reading a lot of different sources. So that was fantastic. we have a question, and anyone, please feel free, type in questions. If you feel up to it, you can just raise your, virtual hand on here and ask directly as well. Related to real estate, not related to real estate, this is where you have an open forum to ask all of your tax-related questions that, normally you have to hire these guys for their service, and they're graciously offering their time here. Chioma has a question, Paul, related to real estate. What about new constructions? When does the participation hours start to count for short-term rentals? If you purchase the lot, when do you start to count?
That's a great question. This all starts counting once the property is in service for rent. That's very simple.
Okay.
Yeah.
And while we hopefully have some more questions filtering in, how does something I get asked a lot in terms of real estate, how does it work with syndications or more passive investments? If you're a limited partner in a syndication, let's say you also have active investments and you reach like a real estate professional status, do the losses from these passive investments, can you count them against active income? I guess that's question
Sure.
one.
Sure. Now, it's different rules when it comes to rentals and real estate syndications. If you do own a certain percentage, you may be able to do that. Now, it depends on the activity, of course, but it does depend on the ownership percentage.
Okay.
Yeah.
And then in general, can you just briefly go over if you are investing passively, you don't have real estate professional status or anything like that, you're just investing passively in a syndication, how do the tax benefits work there? And what are the limitations of the tax benefits in a syndication?
Well, if you own, let's say, less than 5% in that real estate syndication and you do have the losses, then you may be able to take advantage of that.
And those that could go against passive income, correct?
No, you may be able to do the offset that could be active too if you materially participate in them.
Okay, gotcha.
Yeah.
For the most part, if people are investing a small portion, a little percent in a syndication, they're not materially participating, then that would just offset any passive gains they had.
Correct. Yes.
Okay. Got it.
Yeah.
And that's certainly, even at this conference I was just at, there's a huge debate in a panel on kind of active versus passive investing in real estate and advantages and disadvantages. And certainly the tax is something that is an advantage more so for active real estate investing if you reach these kind of criteria, which you listed out really nicely. And that's exactly what my wife does to reach those criteria and get those benefits. I was actually looking around here because I'm in my office, but we keep like a physical log where every day we write down exactly what, she did and everything like that, just in case. So definitely something that's really important, like you mentioned. Khalid has a good question here. Does putting our real estate investments in a business entity such as an LLC help with taxes? So maybe you can answer that and then also go over a little bit the different types of LLCs, or the different types of entities available, and some of maybe the advantages and disadvantages.
Sure. Now, LLCs, federally speaking, are disregarded entities, and typically just owning real estate inside one LLC helps you with liability protection, but just owning an LLC like that does not help you at all with taxes by any means. You're just simply protecting yourself from liability, and you're still listing it on your Schedule E if you have, one or two properties on the side that you fully own. That's exactly the same tax-wise as if you own it with your personal name. Now, going through the different entities, maybe a partnership is, something that you would consider if you have, you're investing with some other partners, like, if you have siblings or friends, you want to invest together and you don't know how to split it up. Owning it in a partnership is ideal. We typically want to avoid owning real estate in S Corps or C Corps, generally speaking, because even though when you want to come and sell, and even though you might want to do a 1031, for example, that will still trigger a taxable event. So the whole point of the 1031 is to defer the gains, but that may still trigger a taxable event if you do own it in an S or C corp. So we typically advise people, if you do want to open an entity and own real estate inside of it, is to only have it in either an LLC or a partnership if you are participating with other members.
Okay, awesome. Yeah, I think that's a really great point, and something that I see a lot is, you know, how does the LLC impact tax-wise? And generally, you know, for something like this doesn't, because it's going to be a pass-through entity. Meaning, like you said, it just passes through to kind of your personal tax return. Okay, general sort of questions. What are the biggest mistakes that you guys see? Let's break it up, that you see employed physicians or medical professionals making, and how do you guys kind of address that?
I'll hand that to Lubna to answer.
Okay. So as a high earners physicians, what I've seen so far, they don't max out the retirements. That's very simple. They invest in real estate, and they are really misunderstand the difference between passive losses and active losses. And that's why I asked Paul today to focus on this point, because it's always great for you guys to understand the differences. They think if they buy a building, I get phone calls like, I just closed on a building, I'm gonna generate all the losses, I'm gonna deduct them all against my business income or my active income. And I'm like, no, you cannot do that. If you want to buy the building, you go ahead and buy the building. But in order for you to, this is passive losses here, if you want to generate that, because we're going to do the cost seg, we're going to do the bonus depreciation, we're going to generate a huge loss there. It's passive. But if you want to turn it to an ordinary losses, there is ways to do it, of course. So we got short-term rentals, and we got grouping. There is another thing, something called electing to group the active business and the buildings. If you operate your business inside this building, you're allowed to do, but the problem is if you elect that, you have to get IRS blessings for it. So in order for you to switch or convert the passive losses to ordinary losses, so you can offset it with your income. Technically, or simplified way, it's instead of putting the assets in the business balance sheet, you have separate balance sheet, but you group them all in a tax election in the tax return. So that's one of the ways as well. That's misunderstanding between the passive losses is not deductible towards the ordinary income. That's a major thing that I've seen so far. Most of my physicians, doctors, surgeons, dentists, they all, they don't have a clear understanding of this thing.
How about for physicians who own their own practice or
the buildings?
Yeah, or just, yeah, the buildings themselves or own their own practice and are 1099, physicians and stuff. What kind of mistakes do you see them making? Or I guess better put, what are underutilized strategies, whether real estate or not?
Associates, actually, if they receive 1099s, I have floaters, like doctors, they float between practices. I have oral surgeons, they go between dental practices and provide surgeries. So they get a 1099. There is a lack of understanding. They keep themselves in a Schedule C. That's really huge self-employment tax there, because they bring about 750 to $1 million in 1099s in Schedule C. That's a killer for them. And you try to explain it to them. Some of them, they are really, they don't want to have another tax return to file. They don't want to have separate the entity, because Schedule C or it's a sole proprietor, it's disregarded entity. It's part of your personal, unless you separate it as an S Corp or C Corp, or you become a partner with somebody. But the LLC itself, Schedule C, it's part of the personal. So that's another thing I've seen a lot. There is a huge tax savings with the 1099 recipient Schedule C, but there is more we can generate if we separate you from your personal. So that's another thing there, yeah.
Okay, awesome. And like I said, please feel free, any of your questions, no matter basic, advanced, throw them into the chat and we can answer them. Paul, can you talk a little bit about the current like phasing out of the accelerated depreciation? And then I'm curious your your forecasting, which I know how difficult it is, but I know there is legislation that's kind of floating around to bring back 100% bonus depreciation, but probably will not see movement obviously until after the election. So maybe can you explain how that works and then what your guess is about the future of this?
Sure. So when Mr. Trump came into office, he enacted the TCJA, the Tax Cuts and Jobs Act, to take into effect in 2018, and that will phase out by 2026. And what he did was he raised the bonus depreciation level to 100%, meaning in my example that I presented to you, that $56,000, when I have bonus depreciation at 100%, I can take the full amount, the full 56 grand, and expense it in year one. Now, what he also did, he started phasing it out. 2 years ago was the last time it was 100%, which was 2020. Last year, he phased it to 80%. This year, it's at 60%. Next year is 40. The year after is 20. And then it's going to be 0 if nothing happens. Now, you might be thinking, well, does that mean the 56,000 that I was going to expense, is that going to be 60% only? No, you can still Section 179 those expenses, which is another form of accelerated depreciation. But typically it's much easier to bonus depreciate something because Section 179 in the tax code has way more restrictions depending on the asset that you're trying to depreciate. So you talk about forecasting without shoving politics down anyone's throat. I think one way or the other, they will at least put bonus depreciation at hopefully at least 50%, and they maintain that. Now, just to keep in mind, these presidential candidates may be proposing anything they want, but they have to be in the form of a bill and go through the Congress to really put into law. So anyone can propose anything, but really, it doesn't really matter on who is the president as long as the Congress is willing to actually push for it. So, I know we hear one particular candidate talk about it more than the other, but I think they'll find a way to, I don't think it will be 0. I don't think it will be less than 50% if that's what you're asking. We'd love to see it at 100%, and we'd love it if it was permanent. But I would say at least it's going to be at least at 50%. They will push something through. And typically when it comes to tax bills, like you hear the child tax credit, as a hot topic. Now, typically it won't just be a bill of child tax credit. They will add in bonus depreciation to that child tax credit bill, which is what they tried to do earlier this year. They were trying to push this child tax credit bill. And in that bill, they actually were saying, let's put bonus depreciation at 100% permanently. And that's under the Biden administration. So as I said, it really doesn't matter who gets elected. And we see that, okay, they're actually trying to make it back to 100% because everyone likes it, especially the congressmen. They love this rule. So it's not just because the people want it, they want it too. That's the main reason. So no matter what happens, I think they'll work something out, and I don't see it going back down to 0. I bet you they will do something before it even gets to 20%.
Yeah, that's what obviously I'm, biased in hoping for that. But I think it makes sense too with especially, the housing shortage and stuff to incentivize, obviously, buildings and rentals and investments in property and stuff like that. Khalid has a good question here. For pure W-2 employed physician earners like myself, what are some commonly missed tax saving opportunities beside missed tax saving opportunities for itemized deductions besides the usual things like mortgage interest, property tax, etc.?
No, your mic is muted. Yep.
Should I take this question?
Yeah, go ahead.
Sure. So before we go back to this question, I just want to add something to Paul's note. So for Section 179 restrictions, Section 179 is limited to the taxable income. So a lot of people don't know that. So yes, you have Section 179, you deducted, but if you don't have enough taxable income at your personal tax return, you will carry forward the balance until you use the full amount. That's something really Not everybody knows about it. So for W-2 earners, Schedule A, well, we have medical expenses. You have to have as a floor of in excess of 7.5% of your AGI as a floor. You have the SALT, the taxes are capped at $10,000. You cannot do anything unless you own a flow-through entity where you can have the pass-through entity taxes paid at the business and then take advantage of it at the state level. Charitable donation, mortgage, of course, charitable donation, you have multiple, there is some charitable donations dollar for dollar, and then some of them are $4 for every dollar you donate or you / invest. That will give you some leverage there. It's called leverage charitable donations. Technically, that's what we have. They changed Schedule A. So to these, they limited so many deductions from there. So technically, that's what we have. So the leverage charitable donation, it's the only option for high earners W-2 beside maxing out your 401k or Roth 401k. Now, if you are really high earners W-2, I suggest that you switch to Roth 401k and you max out that. You're not going to have any tax benefits there. It's going to be higher taxes actually, but at least you're saving on the long run, so you're not going to pay taxes when you retire. But technically, Schedule A is just leverage charitable donation. That's the only one, or any charitable donation dollar for dollar. That's what you can invest in.
Awesome.
Yeah.
Well, that's perfect. That leads us right towards the end of our time, and
Sure.
I'm respectful of your time and everyone else's. This, like I said, honestly, I think that was the most clear presentation of this, which is a very complicated topic. And as always, I appreciate your guys' advice and expertise, and I know everyone here does as well. So thank you so much, everyone who joined. I hope you learned as much as I did and got as much benefit. Paul, Lubna, as always, thanks for your time and commitment to our community. And have a great night, everyone.
Thank you. Good night.
Thank you so much.
Mhm.